All right, we'll go ahead and get started now that it is 2 p.m. Central Time. Good afternoon, all, and good morning and aloha to those who may be joining us from Hawaii. Thank you for joining the latest installment of our Harvesting Value webinar series. Our goal with this monthly series is to provide you with information and resources to help you make important decisions for your operation. My name is Sarah Pelkey. I'm part of the marketing team here at American Ag Credit, based out of our Greeley, Colorado office. Before we dive into our presentation, I'd like to remind everyone of a few housekeeping items. You are welcome to submit questions anytime during our presentation. Again, the Q&A feature at the bottom of your Zoom taskbar is the best place to put those questions. We will do our best to address any questions that come up and as many as possible. If we're not able to get through all the questions, we will follow up with those after the presentations. Additionally, this will be recorded and we will share the link to the webinar with all attendees afterwards. If we have not yet had the pleasure of working with you, American Ag Credit is part of the Farm Credit System, an agricultural lender that supports farmers and ranchers with reliable credit. Our sole mission is to improve the lives of fellow Americans by sustainably supporting agriculture so Americans have access to nutritious and a sufficient food supply. Our teams focus exclusively on agriculture. Many of our employees own farms and ranches or even grew up on one. From small to large operations, we understand the industry and how to structure loan solutions to help our customers achieve their goals, protect their legacies, and grow our industry's next generation. Our presenters today are Don Close and Michael Redmond. Don is Terrain's Chief Research and Analytics Officer. Don's prior experience includes work as a senior animal protein analyst at Rabobank, a market director for the Cattle Feeders Association, where he worked on all economic and market-sensitive policy issues for the cattle feeders in Texas, Oklahoma, and New Mexico. In his over 3 decades of professional experience, Don has been a licensed commodity broker, handled risk management, pricing for large cattle operations, managed grain procurement program, published market updates and outlooks for cattle and hogs. He has also conducted research on a wide range of topics, including confinement cow-calf operations, dairy beef crossbreeds, breeds, and the development in international trade. Lots of stuff. Don is going to give you a current state of affairs and outlook for the cattle industry in the United States, as well as an overview of current market conditions and signals for the remainder of 24 and into 25. After that, we'll pass it over to our American Ag Credit crop insurance agent, Michael Redmond. He's going to give you an overview of the Pasture, Rangeland, Forage, also known as PRF, and the Livestock Risk Protection, or LRP, crop insurance programs. PRF is utilized for grazers and forage operations to manage risk and offset revenue losses during periods of low precipitation. Michael will summarize how the policy works, including the Rainfall Index, coverage levels, and productivity factors. He will also outline LRP for us, the coverage levels and pricing, and how the policy can help producers protect against any national marketplace volatility. Thank you again for joining us. And with all of that, I will turn it over to Don.
Hi, good afternoon. Thank you for allowing me to be with you this afternoon. My comments are going to be to really compress today, but I think I'm giving a really good overview of just what we see as the key drivers in the market right now. Go ahead and roll the chart, please. There we go. So the first slide I'm going to start with, this is from the July monthly cattle on feed report. Once a quarter, USDA provides us a number for the percentage of heifers in the cattle on feed mix. We'll have an update on this one with the October chart just less than a month from now, so we'll have a refreshed view. But as of July, 39.6% of the cattle on feed were heifers. The brown tan line across the middle there between 36 and 37%, that's just kind of the neutral zone. Within that 36 to 37% area, we're not expanding, retaining females for expansion. We're not liquidating. We're just holding our own. So you can see that first off, we're the 7th year into liquidation. So overall numbers continue to contract. And say to get from the 40% level that we've been running to anything below 36%, as of today, with monitoring placements from individual locations, monitoring the percentage of heifers in the sale barn mix, we're absolutely convinced that even with the 15% reduction in cow slaughter for 24 year to date, mathematically we're still contracting and will be as of Jan 1 of 2025. The other part of this chart that I think often gets overlooked is the fact that we're now in the 7th year of liquidation, and given the consideration that that female was at a minimum a 2-year-old when she entered the permanent herd, we're not only not expanding with the retention of heifers at the front end of the market, but we're facing an escalating number of loss of cows due to attrition on the back side of or front side of the market. So, in short, we're burning that candle at both ends. As a summary of this chart, we're still very much in a contraction mode, and have not yet seen. We've seen some anecdotal evidence, but nothing to have us convinced we've got any assertive effort for heifer retention whatsoever. All right, next slide, please. So without going too far into the weeds, this is a regression. We're looking at the comprehensive cutout value on the x-axis. We're looking at all fresh beef prices on the y-axis. You can see the 2020 and 21 for the COVID years and the disruptions that caused to the market, the spike in retail beef prices. For this work, we have omitted those 2 years because we think they're outliers. But when we admit those 2 years, it gives us an R square on that relationship of a 0.72. Here's the point I want to make from this. We continuously see a lot of commentary in the marketplace, articles being written talking about the negative impact that inflationary pressures excuse me, are having on consumers, and that they're just not buying beef, or there's a lot of fear in the marketplace that we'll see consumers back away from the fresh beef case. We've got the regression study. We've also taken the regression and we look at the retail beef price. We match it up against the consumer price index, and we look while there's quite a shock with an average retail beef price at $8.15, but when you compare beef prices in relationship to all other goods and services and the inflationary impact we've had for the last 3 years, beef's right in line with all other goods and services. So we also look at this one. We look at real per capita expenditures, and with that study, it enables us to compare beef in the aggregate to the other proteins. It enables us to look at prime beef, to comprehensive, to the branded products in relationship to comprehensive. Can we go so far as to think that consumers might be trading down the beef ladder and buying items that are not quite as pricey? Yeah, I think we have to acknowledge that some of that's there. But overall, when we continuously see the commentary in the marketplace about consumers backing away from the beef case, we simply don't have the data to support it. In fact, we still think that beef demand is incredibly robust when we look at it from consumers' purchasing power, or we look at beef in relationship to both pork and broilers. Our argument is that beef demand is still very good. So the first slide, we're still contracting the herd. This slide shows that demand is still very, very solid. So there's the opposite ends of the market. Contracting supply, still very solid demand. Next slide. So the one fly in the ointment that's causing us a lot of grief currently, as of the last week's data, which is two weeks old when we get it, but the calculated steer and heifer carcass weight at 906, we're feeding cattle to incredibly large live weights. It's that additional tonnage that we're getting from that increased days on feed that's causing a lot of agitation in the market. I think it's a good explanation for the softer than expected market that we have seen over the last 6 to 8 weeks. When we take the current carcass weights, the rate of escalation that we're seeing, I think it's entirely possible that by the time we get to the seasonal peak in carcass weights, that should be sometime in the second half of November, we could see carcass weights as high as the 918 to 920. So this is going to continue to be the irritation that's in the market. I think we will ultimately work around it, but it's going to continue to be an issue. You know, simply put, when you took current cost of gains in the, let's just say 95 to as much as $1.05 on cost of gain, but we have the opportunity to sell cattle currently in a range of $1.83, $1.85. That incentive to put on additional pounds when value of gain is that much over the cost of gain, clearly producers are being hugely motivated to make these cattle as big as possible. There's other motivators in there with the grids and producers, that group of producers that's feeding for the quality grids are feeding cattle to just as heavy weights as they can as well. So this is going to be, say, the big lookout that we have in the market, certainly for the remainder of the year and very possibly into next year. I know one of the early questions we had come in was, are we expecting to see cattle on feed numbers decline? Absolutely, we are. In fact, I would go so far as to say I'm surprised we've been able to hold the cattle on feed inventory at or above year-ago levels as long as we have. Numbers are going to continue to contract. They're going to contract not only because of availability, but they're going to contract once we ever get to that aggressive heifer retention that is expected before we really start to rebuild this herd. All of those factors are going to draw down that available supply of cattle. I think the real reason that weights I'm sorry, the reason that the on-feed number has held as long as it has is the additional days on feed that's being driven partially by supply, partially by the market conditions we've already talked about with the cost of gain to value of gain incentive to make them bigger. Next slide. So when we started the year here, and you can see all our different projections out there, you know, the first half of the year, the market was performing incredibly well. We did see an all-time record high in the spring of $2 on some corn belt cattle. We've got grid values at and comfortably above that $2 level. You know, the sell-off in the market since the 4th of July has been certainly every bit as much as we expected, if not more. But when we started the year, we were looking for a seasonal low in the market of the $1.80 to $1.85 level. It hasn't been a comfortable ride to get there, but it's still, the market is holding within the projections we had at the beginning of the year. as supplies start to contract, as we'll start to see improvement in cutout values in just the next few weeks, as retailers, HRI customers start to assemble middle meats for the holiday season, we think cutout values will recover. We think that packer margins will continue to be at or stressed just below break even, with some friction in the market there. But our expectations are we will see fed cattle prices get back to a range of 190 to the $2 level as we get late November, early December. We're not expecting to see that late sell-off in the market from early November through the end of the year that we saw in 2023. All right, last point I'm going to make. If we are able to see fed cattle prices recover back to that 190 to an extreme of $2 level, how does that set us up for 2025? If we can close the year in that higher price level, it's going to give us projected prices for spring highs for the first half of 2025 in the 220 to as high as 225 level. In short, we still have a very robust outlook for the market. The point that I will close with is when you look at the available cattle on feed, the fact that we have not retained any started retaining females. If you look at the solid demand base we're seeing for the product, the threat we're seeing from carcass weights, our outlook for the market is still very, very strong. But with these conflicting influences in the market, I think that volatility is going to continue to be a huge factor. And to the point, I think that to participate in this market at these price levels with this kind of volatility, it is absolutely imperative that producers have some kind of price protection in place. I'm not going to go down which avenue I think better. I think that's a different scenario for each individual producer. But I do think with the profit outlook that's in the market, the volatility that's baked into this market, it's just imperative that risk management programs be in place. With that, I'm going to step aside and turn things over to Michael, and then we will be open to Q&A as we wrap up later today. Thank you very much.
Well, thank you, Don. Your knowledge on the cattle industry is extremely appreciated. So we'll go right into a couple different revenue protection tools that we have. The first one is Pasture, Rangeland, and Forage. It's also known as PRF. It is a federal crop insurance program designed to help protect a producer's operation from the risk of forage loss due to the lack of precipitation. So Pasture, Rangeland, and Forage covers a single peril, lack of precipitation. Coverage is available for grass, grazing, forage or haying, and alfalfa. Available for irrigated pasture or forage. It's a subsidized federal crop insurance program, and there are benefits for beginning veteran farmer ranchers. Basically, you get an extra 10% premium subsidy and no administrative fees. PRF eligibility for grazing, you must have a share in livestock, established acreage of perennial forage, must have a share, ownership, cash rent, lease, and grass for grazing. Haying, so your hay must be intended for haying. You must have a share in the crop. Perennial forage must be planted prior to July 1st of the previous year. So if you're looking at a 2025 policy, the perennial forage would have needed to have been planted before July 1 this year. Okay. Subsidy factors. So the subsidy factors range anywhere from 59 to 51%. If you choose the low coverage level of 70%, you're going to get the highest subsidy factor. However, if you choose the highest level of coverage, you're still going to get a nice subsidy of 51%. So anything in between, there are some differences in the subsidy factor. Obviously, the coverage levels are from 70 to 90%, productivity factor from 60 to 150%, and 1% increments. You can only have one productivity factor selected by county, crop, and intended use. The Rainfall Index is based on historical data dating back to 1948. So it uses the NOAA weather stations, and there are 15,000 of them throughout the United States. It's the same data used for the U.S. Drought Monitor and Palmer Drought Index. Index intervals are selected in 2-month periods. You must select at least 2 intervals. The option to insure in all 6 intervals or select intervals that are most critical for rainfall in your area. You cannot insure back-to-back intervals in the same grid. So for example, if you chose to insure January and February in a grid, you would not be able to insure February and March in that same grid because you would be insuring February 2 times. However, if you have 2 grids, then you could insure January, February in one grid, and then you could insure February and March in the other grid. A claim payment is made when the final index is less than producer's trigger grid index. So just to give you an example of that, let's say 60% of average rainfall fell and you had 85% coverage selected. If you had $15,000 of liability in that grid interval, then about 25% of that is going to be paid in a claim, or $3,750. So this is an example of a grid here on the right. And so these blue lines that are long squares are going to be a grid, and they have the blue numbers here. So each one is 0.25 latitude by 0.25 longitude, approximately 12 to 17 miles apart, or excuse me, 12 miles by 17 miles. Each grid uses a minimum of 4 weather stations. So weather stations closest to the center has the most effect. Weather stations furthest from the center have the least effect. So if you look at this grid 22325, this red dot here is going to be your closest weather station, so that would have the most effect. The dot down here at the bottom by the airplane, that's going to be the one with the least effect on it. So that's how the 4 different weather stations work. The precipitation data cannot be traced to a single reporting station. Weather index reported directly by the Risk Management Agency, and weather stations' locations and data used is not reported by the RMA. NOAA data collected is vetted through quality control process, so extreme discrepancies between weather stations are addressed. For 2025, Hawaii is going to have PRF available to them on the Big Island. The Big Island will use the Hawaii Climate Data Portal information and will utilize a 5-kilometer by 5-kilometer grid as determined by the USDA's RMA. A new county-based value methodology will be utilized due to minimal hay production on the island and limited data on grazing leash rates of the Hawaiian cattle industry. Like PRF and the contiguous 48, producers on Hawaii's Big Island must select at least 2 and can select up to 6 intervals to ensure their acreage. Coverage levels will also be from 70 to 90%. However, they will only be able to choose a productivity value from 60 to 120%. So benefits of PRF. How does PRF help manage your risk? PRF was designed to provide protection against increased feed cost, so supplemental feeding from reduction of grazing forage, decreased forage production due to lack of precipitation, alfalfa tonnage per acre is reduced due to drought, increased irrigation cost due to the lack of precipitation. So important dates to remember, sales closing date and acreage reporting date for renewals is December 1st. Also for new business would be December 1st. The billing date is September 1st of the following year. This is a 10-year premium versus payout grid sample in California. And basically what I want to just let you know about here is when we have your information, we can go ahead and put all your land details into this software program, and it is going to tell us historical averages of each 2-month interval. And then it's also going to show loss ratios, so which ones are paying the most. Down here in the purple, this shows 10 years of history for each 2-month interval. And all of those purple squares are months that paid. And then that you have indemnity payments, you have premium that would have been due, you have a running total. So this is going to give you how much money has been paid out over a 10-year history. So we can look specifically at your land by having the detailed information on it. And we can go through a grid like this that's specific for your grazing or haying land. Okay. So the advantages of PRF is it's flexible coverages. You're not required to insure all your acres. No loss adjustment needed. There's no production requirements. Timely indemnities are paid. Premium is not due until September of the next year. It is subsidized. You just set it and forget it. So for a detailed PRF quote on your land for 2025, find a crop insurance consultant in your area at agloan.com/insurance and access the agent locator button. Okay, so now we're going to go on to LRP, which is also known as Livestock Risk Protection. It insures against a decline in market price within a predetermined time period. So coverage is available for fed cattle, steers, and heifers between 1,000 and 1,600 pounds, feeder cattle, steers, heifers, unborn calves, Brahman or dairy. Steers and heifers weight 1 is less than 600 pounds. Unborn insured feeder cattle must be born and marketable before the end date. Steers and heifers weight 2 is between 600 and 1,000 pounds. So LRP sets a price floor, but does not limit upward price movement. It does not cover death, loss, theft, or any other loss or damage of any kind. It's also federally subsidized, so between 35 and 55%, a little higher subsidies on the LRP. You must have an 80-1026 on file with the FSA to receive the subsidy. That's the conservation compliance form, and that's pretty much for any crop insurance subsidy. There's also benefits for beginning farmer rancher and veteran farmer rancher. It's the same. 10% reduction and no administration fees. Coverage levels also vary between 100% and 70%, and the subsidy factor is going to be greater as you have less coverage. So if you choose the highest coverage level of 95 to 100%, you're going to get a 35% subsidy on premium. Obviously, if you choose the lowest coverage level between 70 and 79.99%, you're going to get the highest subsidy level of 55%. Coverage price and premium is determined by futures options trading closest to the delivery date, slaughter date, or timing of desired weight. Insurance period availability is based on the options trading on the Chicago Mercantile Exchange, otherwise known as the CME. The feeder cattle and fed cattle insurance periods are available between 13 and 52 weeks. However, they are in 4 to 5 week increments. So if you chose 13-week and you wanted to do another one later on, it would be say you wanted to do 15 weeks, you couldn't do that. You'd have to do 17. So there is some gap in between the insurance periods. Purchase date is date endorsement is purchased. Price is available from approximately 3:30 p.m. Central to 8 a.m. Central the following day. Insured must notify agent of death of livestock that is insured within 72 hours of discovery. Must retain ownership up to 60 days prior to the insurance end date. So the end date varies by insurance period. Feeder cattle, you're going to have expected target weight at the end date or sale date. On fed cattle, it's the expected slaughter date. LRP, obviously, you can go from 70 to 100% of expected prices, and these prices and percentages vary daily depending on the offerings from the CME. Billing due date is the month following the end of the endorsement. So, for example, if the endorsement ends July 15th, the premium is due August 30th. The actual ending values on fed cattle, ending value for fed cattle is determined by the Agricultural Marketing Service 5-area weekly weighted average, direct slaughter cattle, live basis sales, steers over 80% choice. And that is a mouthful. The feeder cattle, ending value for feeder cattle is determined by the CME Feeder Cattle Index. Okay, this is just a sample of the chart on the USDA website. It's the 5-area weekly weighted average direct slaughter cattle report. The date we pulled this was week ending 9/15/24. And what we're looking at here is over 80% choice. And then if you come over to the weighted average price, that week ending of 9/15, it was at 182.45. Now you can, if you want to see this report, you can Google it. Just type in 5-area weekly weighted average direct slaughter cattle report, and a link to this will pop right up. So that is the fed cattle. Okay. So on the feeder cattle, there are price adjustment factors for feeder cattle. The program itself is based off of the weight to steer. So that's 100% of the price. Now, if you chose to insure the same weight heifer in the same class, it's going to be 90% of the steer price. So it's 10% less. However, if you wanted to insure a steer that's less than 600 pounds, that's going to be, the price is going to be 10% more. So it's at 110%. The unborn steers and heifers, that's 105%. And so basically everything is based off of the weight to steer at 100%. So we'll just go through a little LRP loss example here. Indemnities are determined after the end date of the endorsement. So if no loss is determined, the producer premiums are due first month after the end date. So let's just say you insured 200 head of 750-pound cattle. That would give you 1,500 hundredweights. Now let's say your price, the floor that you locked in was $231.48. That's your coverage price. And on your end date, the market closed at $223.44. That would be the actual ending value. There would be a difference of $8.04. So you take the 1,500 hundredweights times the 8.04, assuming you have 100% share in that cattle, and your loss will be $12,060. So let's just say your premium was $5,000. They're going to go ahead and pay the premium first, and then they'd send you a check for the difference. Claim form will need to be signed with proof of ownership and sent back to the insurance carrier, and they send those out to you directly. Examples of proof of ownership include sale bills, vet records, purchase agreements, branding records, or a certified statement when cattle are not sold at the end date. So many benefits of LRP. It's a guaranteed price, no asking price or bid, limited basis risk, Any number and mix of head and target weights can be insured up to the limits of 25,000 head per crop year per producer. LRP as an insurance product may be viewed more favorably by lenders than futures and options. It can also be used in conjunction with futures and options. The premium due date is at the end of the endorsement, and it is subsidized. Coverage can be written anytime during the crop year, which starts July 1 to the following June 30th. So we are currently in the 2025 LRP crop year. Okay. Another thing I'd like to talk about is that American Ag Credit, we have access to an LRP analyzer tool. It's available for farm credit customers with a signed LRP insurance application and user agreement. What you're going to get from this is daily or weekly emails that you choose yourself. So if you want to see certain prices at certain weights, it'll send you emails when the market closes. You can do daily quoting. There's a quoting option on this. You can do put option comparisons. It has historical performance. There's endorsement tracking. So when you buy an endorsement, that's automatically loaded into this website software, and then you can go in and see how it's doing as time moves on. Market dynamics, so there's price trends, there's price evolution analysis. It's a very, very strong analyzer tool that we use quite often. So contact your local AAC crop insurance consultant via the ag locator on agloan.com/insurance for a detailed presentation of our industry-leading LRP analyzer. Thank you very much. I appreciate everyone that attended today and took their time to join us and learn about these programs. So if you have any questions at all for us, we'll go right into that.
Yeah, thank you, Don and Michael, for your insights and information. We're going to move into the question and answer portion of the webinar. Reminder, on the bottom of your taskbar, you'll see a Q&A section. Please feel free to put questions that you may have in that space, and we'll get to them as we can. First one up, Michael. The question is there a minimum herd size or head count in which somebody should start to consider risk management for their operation?
Well, yeah, I would say you're never too small to consider it. I mean, you can insure as little as one head. So I've personally had producers insure 20, 25, 30 heads. So I don't think you're too small to join this program.
Excellent. John, this next one's for you. When do you currently expect the current market price cycle to peak?
With the structure we're working with today, the fact is, as we talked about, we still haven't started that heifer retention program. Before we can get those heifers into the system, get their calves into the beef supply chain, we're talking 2 full years. So at this point in time, we're talking the strength of this market lasting through 2027. If we don't start seeing that percentage of heifers on feed start to drop precipitously really soon, we're gonna be forced to roll that outlook into the tightest beef supplies into 2028. The one last point I'd make with that, I think as we see the fall calves that are being weaned and being shipped right now, I think observing the management of those calves during the first quarter and the first half of 2025 is going to give us a real solid indication of if that long-awaited heifer retention has started, or if we continue to slow play this whole cattle cycle out. Early first quarter will give us an indication of whether we need to be adjusting that timetable or not.
Excellent. Well, it looks like we might have an easy crowd, or you guys did such an excellent job of covering. There are no other questions coming in. You'll see in the chat contact information for both Michael and Don and information on how to sign up for Terrain Insights. So please feel free to use those resources should questions come up after you process this information. We're happy to be here to help and to serve you, so please reach out as needed.